This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.
On that report, if you recall, is that if I zoom in here, you'll see I even went so far as to forecast what I thought the volume would do. And I drew this little line down here. I don't know if you could see that, but I said most likely we will see a drop in volume that would signal a release of the selling pressure, or a drop in volume. When a stock is going down, the drop in the volume tells us the sellers are weakening. And the only reason I drew that was because, number one, it was on support, but there were also two minor gaps above the market. And you normally don't see the Dow Jones Industrial Average gap more than 2 times in a row before it starts reversing. So that's what the forecast turned out to be. And if I, again, look at this hammer pattern today, you see this candle from today, what happened? Well, the Dow Jones Industrial Average closed slightly higher. We're up 21 points. But here's my test question to those who have been following along each and every week and every month with the reports and with the open house. What does this long shadow underneath the candle mean? What does that tell us when you have a long shadow below the candle? Who wants to be the first one? Okay, Nathan says it's bullish. That's exactly right. Now, who wants to expand and say why that's bullish? Okay, Amalia says the buyers are coming in. That's exactly right. What happens is, if you were to look at this stock probably midday, if you looked at the market right around midday, this would have been a very long red candle, because midday, let me see, I'll tell you exactly when midday. I'll switch to a minute by minute chart. Actually, it was in the morning right there. Right at, let me see, what time was that? That's right at 10:22 a.m. 10:22 a.m. the market had hit its low for the trading day. You see? So at 10:22, that daily candle would have been all red. And at 10:22, there would not have been a shadow under the candle, which is that vertical line. Again, let me zoom in. I don't want to keep switching and making you dizzy here, but at 10:22, the stock was right on that low right there. So this would have been all red. Now, towards the end of the day, as you saw from the intraday chart, the buyers came in, just like what Amalia said. The buyers came in and pushed the market back up. So the long shadow signifies that the buyers came back with force and were able to push it off the low and turn it from a red candle mid or early morning to a green candle. And that is a very powerful buy signal. Now, on the other side of the coin, when you see long shadows above the candle like this, that's just the opposite. It tells us that the buyers came in during the course of the day, but by the end of the day, the sellers pushed it down. And these long shadows are very, very powerful. They're very, very powerful signals that the average person is not going to pay any attention to. And I'll tell you, if you turn on CNBC or whatever financial channel you have, if you're up there in Canada and you listen to BNN, they will never, ever talk about the shadows, because they don't know what the shadows are. Even the television hosts couldn't tell you what a bullish candle is from a bearish candle. They just don't go there, and they give you the fundamental news, the news of the company, the earnings, the analysts. They'll talk about those things, but they never talk about the technicals. Years ago, John Murphy would be the technical analyst for CNBC, and I had a very good dinner one day with John Murphy. He was part of the Market Technicians Association, and he left CNBC because and this was from his own mouth, he told me they would push whatever the opinion was on that day. They could care less about the technicals. If the sentiment was bearish, they would only bring out bearish news. If the earnings came out and beat the earnings, they would only talk about bullish news, and they wouldn't look at the technicals. John Murphy did his best. He wrote a really good book, and went on to become a very well-known technical analyst that inspired folks like me to continue on with that kind of work. So now what am I doing? I'm trying to teach this to you so that you can read the signals and not get caught, with the other sheep, in a market that could turn on you in a second. So that's the diamonds. I still think we're going to climb up short term. Maybe even by tomorrow or Wednesday, we could most likely fill this gap here. There's a little bit of a gap right there. I don't know if we're going to go all the way up to fill this gap this week, because the end of this line right here is my target. And you could see the name tag that came up when I highlighted that. You could see the end of my target is 219.35. That's right there, 219.35. So by the end of the week, it might be Wednesday, it might be Thursday, I think we're going to hit 219.35, which is the end of the line. It doesn't always happen on a Friday. It could happen midweek, and then we'll see what happens. But again, the end of that line is my target. I'm telling you that. Maybe I'm sounding a little repetitive because I want you to understand how to read my forecast line so there's no confusion there. Okay, now if we look at the Qs, which is the NASDAQ market, you'll see that the same thing has played out with one slight exception, and that is, hold on, let me get in there, zoom in. We do have a long shadow. The only exception is that we closed a little bit lower today on lower volume, which is actually bullish, because you have 1, 2, 3, 4, 5. There's 5 red candles in a row. Who can tell me another thing that we talk about there? What when you have a long stretch of red candles, what is that? What is that called? Oh, we're having a problem here. Can anyone see my screen? Okay. You can't see my screen. Uh-oh. What's going on there? You can't see my screen. Okay, JD, you can? Some people are seeing my screen and some aren't, huh? All right, let me stop sharing my screen and I'll reboot. Let's see. You shouldn't lose my voice. All right. Showing pause main screen. Let's see. Okay, how about now? Can everyone see? Can you see QQQs on there? We'll go back to go and see. I'll point your cursor in the box. All right. Okay, screen is good now. All right. I don't know what happened there, but I'll try watching that Q&A box more closely. Okay, so here we go. Today's candle, long shadow underneath. There's a long stretch of red candles. Who can tell me what the long stretch of red candles is called? Who wants to say that? Okay. Now, just a little housekeeping. JD says people just need to hit the orange arrow. There's an arrow on the top left side. You can hit the orange arrow. That seemed to have worked for JD. So if that happens again. Okay, so Stuart came up with the right answer. When you have a long stretch of red candles, that's called a stale red light. And when you have a long stretch of green candles, that's called a stale green light. And what that means is that when you have a long stretch of red candles, the more red candles you have, the higher the probability of us seeing a green candle to follow. So my guess is tomorrow we're going to start seeing a green candle. Again, long shadow underneath the candle, drop in volume tells us the sellers are losing that momentum. So the forecast from last Friday was that we would move up towards the 20-period moving average and then start to pull back from that, because that role reversal concept that I talked about also applies to the moving average. So in other words, when the moving average drops down below I'm sorry, when the price drops down below the moving average, the price at this point back, excuse me, price back here in early August, 20-period moving average was acting as support. Now the stock has dropped below support, so former support in that moving average is now going to act as resistance. So that's something you got to keep an eye out for, because, you know, especially as we come into September, August is, you know, the end of the summer doldrums, but September, October are the most notorious months of the year. They're generally the months that we have the big down moves in the market. So I want everyone to be very mindful of that as you continue to monitor any long positions. Okay, do we see any questions? No, I don't see any questions. Okay, now I'm going to switch my screen to the spiders, which is the S&P 500. Please let me know if you could see this as I change my screen. 1, 2, 3. It's now on my screen. Spiders. Can you see that? Can anyone? You can see it. Okay, good. Thank you. Thank you, Dylan. Okay, so this is the spiders, and like the other two markets that I just described, same thing. Isn't that amazing? Drop in volume, long shadow underneath. We got a green candle, but with the green candle that we're seeing here, this is very, this should be very familiar. When you have a green candle, or the body of the green candle that eclipses, I'll use that word for today, being that we had the great eclipse of 2017, when it engulfs or eclipses the previous red body, that's known as a bullish engulfing pattern. Now, Steve Nissan and a lot of the other candle experts might say, "Oh no, that's not. It has to engulf the whole shebang here from the previous day." No, I've found that as long as the body, even if it's a small body like this, as long as the body engulfs the previous body, that has worked out for me as being the best buy signals that you can find. So this is a very powerful buy signal that we see in the S&P 500. And again, I wouldn't be surprised if we start moving right up along this line. Now, again, like I said before, the end of that line, which is 245.57, you want to write that one down, you go ahead. By the end of this week, I believe that the S&P 500 is going to hit 245.57 on the chart. So keep note of that. Don't see any questions. Here's question. Oh, yeah, I love to break the rules, Steve. Steve is a good guy. I know Steve for many years. Steve is the master upsell. You buy one little newsletter, he's going to sell you everything that he has in his library. He's in business, boy. I'll tell you, he's in the market to make money, like we all should be. That's your goal, to make money. Learn what you can, apply what you learn, and most importantly, make sure that you learn how to set stops and protect yourself on the way down. Okay, so that's the spiders. I got to look at the clock. We're good on time. All right, now I'm going to look at the Russell 2000. My screen just shifted right there. Make sure screen check. Everyone see that? Okay. Let's see. Oh yeah, Steve does. JD mentioned, but he's basing it on the weekly because that is the basis of the Japanese charting. Well, weekly charts do overshadow or have more weight than the daily charts. But when I'm forecasting, I could take whatever I'm teaching you here with regard to these long shadows, engulfing patterns and things. I could take that and actually apply it to a minute-by-minute chart, and it reads the same way. Look, let me show you. This is a minute-by-minute chart right here of the Russell 2000. Now, if you look right at the bottom here, that is a bullish engulfing pattern right there. At what time is that? That is at 3:15 this afternoon, 45 minutes before the market closes. We get a bullish engulfing pattern. What happened? Boom, that's on a minute by minute. So at 3:14, we had a red candle. At 3:15, we had a bigger green candle. There you go, bullish engulfing pattern. And look what happened. Now, for the day traders, who are looking to make money, they might buy that bullish engulfing pattern and put their stop right below the low there somewhere. And then here again is a bullish engulfing pattern right here. There's another buying opportunity. And here is a bearish engulfing pattern, followed by another bearish engulfing pattern. The last minute of the trading day, we had a bearish engulfing pattern in the Russell 2000, and then after hours, it gapped down. Okay, so we might even open up tomorrow lower, but ultimately close higher. I don't know. Can't say that right now because it's not tomorrow yet, but it could do that. Now, again, on the minute-by-minute chart, let me just show you. Here is a place right there at 2:25 p.m. Eastern Time. The minute chart gapped up, and then it gapped up again. You see these little gaps right here? Well, what happened? Right here, it filled the gap and then gapped down. And then so all of these gaps that are open eventually filled. So here's a gap down, and then it filled here. So why am I showing you this on the minute by minute? I normally don't do this on the open house sessions, but it's really a good idea if you want to practice reading the technical signals and you have time to do this. Maybe you have a lunch break and you could pull up a computer. Look at the minute by minute charts and read them and study them and look at the shadows. See, here's a big long shadow. For a day trader, that would have been a buy signal. Boom. They would have bought it right here and they would have sold it at resistance up here for pennies. They're not in it for days and days. They're in it just to make a couple of pennies on a lot of shares and they're done. You know, so that's the Russell 2000. When I go back to the daily chart, again, you'll see that this was a pretty significant support level right here, that all of a sudden there's hammer patterns showing up with large divergences or wide divergences from that moving average. So there's my target for the Russell 2000. I'm not going to go to the VIX because I want to spend more time watching and reading your stocks. But the VIX did pull back, like I said it would from last week's report. I think the VIX could pull back just a little bit more. But ultimately, especially coming into September, I think the VIX is primed for a major rally. I think if you go and study the weekly charts on the VIX, you'll see again that September and October are generally very bullish signs for the VIX, but bearish signs for the overall market because, again, the VIX is inversely related to the S&P. All right, start typing in your stock symbols. Let's see who's the first one here who wants to analyze the stock. Philip, wow, fast. Okay, Win. Oh, yeah, let me just make sure. Is it W-Y-N-N? Philip, let me see, W-Y-N-N. If you could, just don't type in a stock symbol. Put in what your intentions are, what you're thinking about, okay? And then I will analyze this. Now, obviously, this is a stock we've looked at from before. I'm going to erase these lines so we have a clean slate. I'm just going to clear the drawing set right here. So Philip says he's thinking of selling cash-covered puts to purchase the stock and then write cover call for income. Okay, now, for those of you that do not know options, a cash-secured put is actually a bullish strategy. When you sell a put, you're obligating yourself to buy the stock. Now, Philip, let me just point a couple of things that are really popping off here on the chart. Number one, there is a big gap down below the market here. You see that? Now, the stock is currently trading 135.64. That's where it closed right here. And again, can everyone see my chart? Make sure you can see this. Okay. All right, good. All right, so there's a big gap all the way down here around 128. So that this stock could actually drop almost 8 points before the gap fills. In fact, there's a little bit more of a gap down here. Actually, yeah, it could drop to 126 to fill this gap right here. Now, if you're selling a cash secure put, remember that's a bullish strategy. I personally would wait for the stock to pull back to fill the gap, because once the gap fills, that gap fill point becomes support. That's number one. Number two, if you look here, you'll see that the stock is in a trading channel. You see that? It's a downward trading channel with this 20-period moving average going lower in the mid range of that channel. So initially, with lower highs showing up and lower lows to follow, that does not look like a good stock to be selling puts in. I'm just giving you that. So you wanted my opinion on that, and in the chart read, that's the chart read. So we'll keep those lines in place right there. All right, now Ron says, is it OHI or OIH? Ron, is it OHI? I'll put OHI and see if that's in there. OHI and see what comes up. I'm not familiar with that symbol. All right, is it Omega Healthcare that you're looking at, Ron, and not OIH? Okay, it is OHI. Okay, so Ron is looking for an entry point. All right, now keep in mind, Ron, again, like we just mentioned to Philip, this stock is showing lower highs followed by lower lows. Okay, and again, that 20-period moving average is going lower. The only good thing is that I see on the chart is that there is what's called the Harami pattern, which is this 2-day pattern right here. A Harami, like you see back here, is a smaller green candle that falls within the body of the previous red candle. Harami, Japanese for pregnant, that means pregnant candle. That's the Japanese just called it the way they saw, the picture. But generally, the Harami is bullish. But I don't see anything other than that that's compelling enough to justify a long position. So if you decide to buy this one, what I would do is I would buy it if on the Harami, but if the Harami fails, you have to put a get out point. I would put my get out point probably right below this low right there from August 11th. So that low right around 30, I would give yourself like $1, $1.50 stop loss order on that, and use the 1% rule so that you're not losing more than 1% of your account if you're wrong. But that's really the only positive thing that I see is the Harami, the green candle on higher, very slightly higher volume there. So again, remember to protect yourself on that. Okay, Jim is submitting OPK. Now, Jim, if you could tell me what your intentions are on that. Are you looking to buy it? You're looking to sell it? What? This is a stock that obviously has been in a downward trend. Okay, I'm going to remove all the trend lines here. Hold on, what happened there? All right, hopefully you could see that. And clear drawing set. I'm going to clear the lines. All right, now let me just see if I can find Jim's. Okay, you're long it at 6.5. Okay, all right, that's not too bad. Let me give you a couple things to think about, Jim. First of all, where's your stop? If you bought it at 6.5, you're already down, 36 cents. So where are you going to pull the trigger and say, okay, I've had enough and I'm out? Do you have a stop in mind? 5.50. All right. So you have five. You gave it $1 stop loss. Okay, that's good. Remember that if this stock, if you get out at 5.5 and you're in cash, that's good. But if you violate your own stop loss rule here and let that stock drop below 5, that will be the kiss of death. And what I mean by that is that when a stock drops below $5, I've said this before, but I don't know how many of you really remember this. The margin requirement changes. In other words, the broker requires that anyone who's bought this stock on margin, if it drops below 5.5, they have to bring in more money to maintain the position. Otherwise, they're forced to sell the position. Now, most people do not bring in more money to finance a losing position. So they opt to sell the stock. So when the stock dropped below $5, there's enormous selling pressure put on the stock by the brokers who have margin calls going out to these folks to bring in more money. You see, so you really got to watch that. Now this is the first one that I'm switching to a weekly chart. Again, here's a weekly chart, and I see last week's candle is actually a bearish engulfing pattern, so you got to be really careful with this one. See, here's this very small green body candle. That's a spinning top here, but yet last week was a bearish engulfing pattern, so be really, really careful with that. Your get out point at 5.5 is going to be below the low of last week's low, so that's good. Again, another reason why if you get stopped out, you can't look back at that one. Just get out. All right, so hopefully that helped you out there. Okay, now, Bruce, did you put a? Oh, I see. Here we go. I'm out of sequence here. Okay, Michelle Riggs is looking at KMI. Now I'm still on a weekly chart, Michelle. Let me know if you could see that. KMI, does that look good? All right. So let me go back to the daily chart on this one. KMI, which is Kinder Morgan, is actually showing some fairly positive signals right here, even though the stock has been down. Let me rattle these off to you, Michelle, so you can take good notes on this. Number one, the stock has bounced off of this key support level back here from, what day is that? It's bounced off of the May 31st low. That's positive sign number one. Positive sign number two is that you have a wide divergence from this moving average. We call this the rubber band effect. Again, for those who are brand new, when you have a stock that is stretched that far below or even above that moving average, stocks do not generally stay that far above or below. They snap back to the moving average. So you have the rubber band effect actually work in your favor if you're thinking about buying it, and you're thinking about buying the January calls, the 13 calls. So that's a good thing that the divergence is there. So the other good thing is that you're thinking about buying a long-term leap at the $13 call. But let me go look at the options here. Again, for those who don't trade options, bear with me as we go through the menu here and look at the January calls. This is nothing more than an Excel spreadsheet on steroids. That's all this is. So you get the columns and you got the rows. The $13 calls actually look like they have enough liquidity to keep the spread pretty tight. So you have 560 to 580. Michelle, if you're thinking about buying those calls, I don't think you have to rush in and just take the asking price. I think from the looks of the volume, they just might trade those at 580, maybe 590. So I think if you do buy those, you can get a better price than what's being asked right now on the closing market. Okay, so that's a good thing. Now, the other thing is that you just got finished with a long red stretch of candles, which is the stale red light. Remember, we just talked about that. This was a stale red light, and this green candle that showed up is the end of the stale green light signaling that pivot point. So you got a clear support level, a clear pivot point, you got a stretch of the moving average. That all looks good. Now, even though the calls are fairly cheap, they're under $6, Michelle, it's a good idea to at least establish a get out point, okay, for the calls if you think about buying those. So what I'm going to do is I'm going to back up and show you that you have more or less a role reversal from this area of resistance up here. You have a role reversal line pretty much there. So that's a double support. You got the support from the lows, but you got the role reversal effect here. Notice I didn't put them at the highs. I just kind of took a mean of these highs in here and drew my line of resistance from there. It broke out through here, now turning to support here, here, and here. So you got the daily chart confirming the buy, you got the weekly chart confirming the buy, and you got all the other signals that look pretty good. So hopefully that helped you, Michelle. let me know. Keep me abreast of what's going on with that position. I'd like to help you out with that one. Okay, Bernie. Bernie put in Apple. Bernie, if you could, I'll watch for your response. Tell me what your intentions are with this one as I pull up the stock. AAPL is the ticker symbol. And let me get rid of all these lines. I had drawn fan lines last time we looked at this one. So again, Bernie, I'll wait for your response to see what that is like. Hopefully you could all see my chart. Okay, Bernie wants to know if he should hold the stock. Well, I guess that means that you're already long it. Now let's build the role reversal first, because that's the first thing that pops out on the chart. You have these highs back here. You see that, Bernie? You have a high here, high here. I could draw a horizontal line from that, and notice how the horizontal line from these highs matches up perfectly with my 20-period moving average. So remember what I said before. The 20-period moving average is going to act as support like it did here and even like it did back here, okay? So the 20-period moving average is going to be more or less your break point. If you see the stock break down below the role reversal and then it even closes below that moving average, that's what you have to watch out for, because if it closes below that moving average, there's a good chance it's going to make a move to fill this gap all the way down here, which is around 150. So you don't want to risk, the $7 that you have now in the stock at 157 and ride it all the way down to 150. So what you could do is put a stop maybe even below this low. Maybe, what's that low? That is, the low is 155.11. So you could put a stop at 155, which will bring you to the point below that support level. And then what you do is you watch the stock, and if it comes all the way down to fill that gap, what do we expect to happen? That's a test question, by the way. Who could tell me, when a stock fills a gap to the downside, what happens 80% of the time? After the gap fills, what happens 80% of the time? Okay, Nathan says it bounces. That's a good answer. Well, 80% of the time. Okay, Dylan, right? Same thing. Jerry has the most accurate. Nathan and Dylan, you're right. It does bounce, but Jerry hit the nail on the head. It reverses. 80% of the time, after a gap fills, the stock reverses. And you can see that if you look back, there are still some open gaps on Apple, but the ones that were filled, even here, look, here's a gap. It gapped up, and on this day, the gap filled. See, here's a gap that was filled, and then after the gap was filled, it reversed and went up. That's exactly what we would expect with this one. If the gap below the market fills, we will expect it to trade up from there. So Bernie, if you get stopped out up here, don't worry. The stock is most likely going to give you another chance to get back into it. So hopefully that helps you there. Okay, so let's see. Bruce, Bruce, will you have could drop to 118. I don't know which stock. I may have lost you on that one. Okay. That was the other stock we talked about. Okay, now D McLean is looking at FOLD. I don't recall this symbol ever. I have to see what that one is. All right. D is looking. He owns it, but considering raising stakes. D, I don't know if you're male, female. I only see the letter D, so forgive me if I addressed you incorrectly, but let's take a look at this. You own it, but you're considering raising the stake, meaning buying more. I'm assuming. If you can clarify, I don't want to guess at that. Okay, so FOLD is looking to me pretty bearish right now, and the main reason was a couple of reasons actually. I see that there's a gap below the market right there. You see right around 1080. So there's a good chance it could go there. The other thing is what used to be support. You see how the 20-period moving average is acting as support here, 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 and even here. The stock now has broken down below the 20-day moving average, and the 20-period moving average is now going down with the stock's highs, excuse me, the stock's highs are now hitting that moving average's resistance. So I wouldn't necessarily raise the stakes, but what I would do is protect your position, protect any profits that you might have. Again, I don't know where you bought into it, but if you have any profits, you definitely want to be protecting the profits at that point. Now, I would say you don't even have to wait for a stock to break down below support. What I would do is look for any kind of a bearish sign up here. You know, if tomorrow you have a long shadow above the candle, that would be bearish. If over the next couple of days you see a bearish engulfing pattern, obviously that would be bearish. See a big red candle on high volume. See, now the volume is going down as the stock is going up. That's bearish. Remember, if the stock is going up, volume is dropping, that means the buyers are losing momentum. So if all of a sudden you see a big red candle here over the next few days on higher volume, that tells us that the sellers are becoming motivated. Look back here. See that bearish engulfing pattern right at a resistance point? Wow, that's a big sell signal right there. Bearish engulfing pattern at resistance. So you got to look for those types of things. But I don't know if I would raise the stakes and take a bigger position, especially coming into September. Yeah, again, look at the history, and you'll see September, October, like I mentioned, are pretty bearish months. Okay, let's keep moving on. We got a good pace going here. So let's see. Bruce, hey Bruce, welcome back. Is asking me to look at IMAX, IMAX. Hopefully you can all see that right now. And in BC spread, March 1520. So that's a bear call spread. I imagine the BC stands for. So you're in the 1520 bearish call spread, meaning you're short the 15 calls. That's pretty gutsy to sell in the money options. So far, that's working out for you, Bruce. And if you had that on for a while, chances are you're up on the spread. But let me just say this. It kind of in reverse. It's interesting because you already have a bearish position, which is good. It fits the trend. But let me just point out what's going on. The stock is going down, but today the volume is going down. Is that bullish or bearish? We'll just put a checklist together. If the stock is going down, volume is going down, that's bullish. You got to watch that. You have a wide divergence from that moving average. You see, although it doesn't look like it's very wide, you can see in the past that the stock does not like to stay that far away from the moving average. So that is bullish. Okay. The other day, which is Thursday, you had a bullish engulfing pattern. Hasn't played out yet, but it's not over yet. A lot of times the bullish engulfing patterns will play out, mere a week even later after it shows up. Here's a bullish engulfing pattern that didn't work out, but we have another bullish engulfing pattern right there. So you got to watch that. I would say this. Switch to the weekly chart. Let's look at this now, and you'll see it's a very, very different picture when you go back from the weekly to daily and back again. See, this obviously shows the downward trend, but the weekly chart shows a much more severe downward trend. Now, let's analyze this on the weekly chart the way we would the daily chart, okay? You have a bearish engulfing pattern here, but look at the weekly volumes. See, the highs on the weekly volumes are dropping. And what that tells us is that the sellers, again, are losing that selling momentum. Again, all these signals tell me if you have a profit, take the profit. And then move on to another stock that has a little bit more convincing bearish signals. than this one. Okay, so that's my spin on that. All right, Ken Wolf is looking at EPD, and well, we started on the weekly chart, so I might as well begin there on this stock. Ken tells me calls at 25 to December. I don't know what that means. Ken, does that mean you're long the calls at 25? You're long the December 25 calls? I'm guessing, but please clarify that for me if that's a yes. Okay, yes, you're long those. Okay, now you're long the December 25 calls. Those are at the money calls. Now, again, those who are equity traders, take this as a lesson. At the money calls have the most time decay, so that's going to work against you. Number one. Number two, you have a level of support here on the stock that's right around 24, and the stock is moving towards that support level. The only bad thing is, Ken, is that if you look at the volume is increasing as the stock is going down. Now, this little blip here is only because it's a weekly chart and it's Monday. By the end of the week, this is what I would say you would have to do. If at the end of the week on Friday, you see lower volume, I would stick with the position. If you see higher volume, it means that the sellers are still very much in force. And over the next 4 weeks, they could keep pushing it down to 24. You see? That's how you have to watch that one. The only good thing that I see on the weekly chart here for you is that you have a stale red light going. So we're long overdue for a green candle. But I don't see that stock rallying up with any kind of gusto that'll help you out. Again, I don't know how much you paid for those calls, but it could. I'm saying best case scenario here is that it would rally back up to the 20-period moving average right around 26.33. Because if you look, you got a bullish engulfing pattern from last week. You see that? I don't know if that's when you bought the calls. You got a bullish engulfing pattern from Friday. The daily chart is showing lower volume, but that weekly chart, you got to watch that. Okay, so here's what I would expect. I don't know if it'll happen this week, but I think that the stock could move up to around 26. At which time, if you have a profit in those, I would get out of them only because they're not leaps, they're calls. And at the money calls, like I said before, will have a lot of time erosion that'll work against you. So be careful of that. Okay, let's see. Let's see. Looking for the next stock. Did I miss? If you folks could retype your stocks in there, it kind of got washed through the system. Okay, Ron is asking about TU, looking for an entry point. We type that in, TU, and hopefully you could all see my chart. TU. Oh, I like the bullish engulfing pattern here, Ron. Already, my gut instinct is telling me today's the day or tomorrow's the day if you have a green candle to buy that. Couple of reasons. You got the stock just last week bounced off of a key roll reversal. Boom, there it is. See, former resistance here and here was broken here, turned into support the very next day, held support here, and you got a bullish engulfing pattern on higher volume. That green candle higher volume is very good. Now, if you get in, Ron, very important, this stock looks like it's like in a trading channel here. I don't know if you could see this. Can you see if I draw the trading channel, maybe this will help you. You see, it's got a kind of interesting trading channel. There we go. What I do, by the way, for those brand new to technical analysis, I take as many lows as I can and try to connect them using more or less a straight line to draw the trend line. A lot of times when I draw that trend line, I try to match it with the 20-period moving average or what the 20-period moving average will look like as far as an angle. So there's my trend line. To draw the channel line, you have to find some highs that you can connect that will run parallel to the trend line. That's how you construct a trading channel. And although it's not at the bottom of the trading channel run, like we said, we have a bounce off a role reversal last Monday. So there is a good chance that this stock will rally back up. I would put this one as at a price target right around here. That's right around 36.70. So I'm only expecting maybe $1 higher on this one before I would be taking my profits. So if it does go up, if you take a long position, I would put my stop maybe somewhere down below this trend line or roll reversal. Protect yourself immediately using the 1% rule. Go to my video page to learn about the 1% rule if you haven't done that already. And put your stop somewhere down here to give it room. And then as the stock goes up, you want to watch the volume. And like we say each and every week, if the stock is going up, and the volume is going up, that's strong. So you hold the position for as long as the volume is increasing. But as soon as you see a drop in volume at these highs, game over, take the profits, run, go on to your next stock. That's trading. By the way, I'm not showing people how to invest. That's not what we do at the Market Guys. We are, by definition, we are swing traders. Investing is when that's what Warren Buffett does. He just parks his money with undervalued stocks and leaves it there and collects dividends. That's not what we do. If you want to invest, that's a whole different strategy. I would even say go find an advisor that'll manage your money to help you invest. I am showing people how to trade the markets and these price swings that we call trading legs. That's what that is. So here you have from this low to this high, you have a trading leg. It's an up leg. From this high to this low is a trading leg. We're looking for the next move up to show the next trading leg, and that's what Ron is looking to capture. So hopefully that helped you out. Okay, Hendra, welcome. Let's take a look at Netflix, and then I'll read your notes. Let me type that in so we have the chart up first. NFLX. And Hendra says long Netflix with cost basis of 166.50. So you're right at pretty much at your cost basis. Please kindly advise where I should put my stop loss order. Kendra, thank you so much. You're the only one. Not that this is bad. It's a very good thing. You're the only one that asks where you should protect yourself and not where your entry point should be or where, you know, what should you do. I like the fact that you're thinking about risk management. Well, you're at a very good place for that. These are lines that I actually drew back when we were forecasting Netflix. And our option traders have a position in this. So I was forecasting Netflix to go lower because I don't know if you could see, there is a bearish engulfing pattern that happened here. So we're long a calendar spread, which is a bearish spread for our option traders. Now let me tell you where you should protect yourself. This would be a gap fill support level. So if this horizontal line is acting as support, you want to put your stop somewhere below support. I would say, depending on how many shares you have, you don't want to go all the way down here to 140, but you want to have this general area from 160 maybe to 163. Somewhere in there would be a good stop level. The good thing for you is that the stock is showing a what's called a doji pattern. It's like a little cross. It's a very small body candle. It looks like a cross almost there. And let me get my charts right. There we go. And so this is actually bullish because on the way down, you see, on the way down, we have a drop in volume today. So this drop in volume today, although it's still a small doji there, that is a positive signal. So that's going to help you. Now, my question to you now, and maybe you could answer me, is where are you going to take your profit? If you long it at 166.50, which is right where we are right now, basically, where are you going to get out to take your profit? That's a big question for you. And I know there's a little bit of a lag there. Okay, 175. I think that's very reasonable. I would say maybe even raise that a little bit because there's a gap above the market. I would even stretch that to 176, maybe 176 and a half, because I would expect the market to go up from here. Now, our option traders are short the 160 puts, I believe. I can't recall exactly the strike price, but we're short puts. So it's okay if it goes up a little bit for our option traders. But for you, the equity trader, that's a very reasonable target. And here's what you have to watch out for. If the stock continues to stay where it is, like from 166 to 170, and continues to trade below that 20-period moving average, this moving average will start to get drawn down to the stock. See, the moving average acts like a magnet, but for the price, but the price also acts as a magnet to the moving average. So they're being drawn together. So this moving average will start to get drawn down. So if it gets up to the moving average and you're right at 175 and it starts to pull back, then go with your original intention of selling it at 175 and then move on from there. Okay. All right. I think I have time for maybe two more stocks. And Bill is submitting LRCX. Does not have any position in LRCX, but he's asking if there's a trade coming. If I can get the screen to show the stock. There we go. All right. Initially, Bill, I don't see anything positive on this. Initially, it's telling me to sell it because remember, when you look at charts over and over and over again, there are signals that just pop off without you even having to analyze the individual candles. The first thing that I'm seeing is actually the beginning stages of a head and shoulders pattern, where this is a left shoulder on a bearish engulfing pattern. Let me zoom in here. Okay, here's a left shoulder with a bearish engulfing pattern, with the head also a bearish engulfing pattern, and a right shoulder with the bearish engulfing pattern showing right there. So I have three bearish engulfing patterns very, very close to the top, if not at the top of these moves, with a gap below the market. And as the stock is going up, the volume is dropping. So there we go. Stock going up here. I'm expecting that in the near term, even by the end of this week, this stock is going to start dropping below the 20-period moving average. So you have a gap down here that will draw it down, and you have a secondary gap down here at 145. And then guess what? You got another third gap down here around 127. So there again, there's nothing on this chart that prompts me to want to buy that thing. I would be very, very careful if you decide to just do it anyway. I would put a very, very tight stop, or maybe even use options to protect yourself. Yeah, this is a candidate where I would even say to the option traders, look for a cover, look for a credit call spread on that one, and maybe we can find something. I'll have to look at that. That might be it. But Bill, that would be my spin on that one. And then that looks like we have all the stocks that were submitted. Let me just tell you a couple of things here. First of all, I really want to thank you for joining us each and every month in these open house sessions. I really, really appreciate that. I look at myself as an ambassador of the charts. I love candle charting. I love teaching candle charting. But one thing you have to remember, that if you're using candle charts as your primary tool for managing risk and forecasting stocks, it is a good thing, a very good thing for you to share those ideas and these charts with people. Share it, because the more people who use the charts to generate signals, the more accurate the signals become. And if you look at any stocks, okay, Facebook, for instance, okay, Facebook came out with some pretty negative news today. I was reading, I don't know if it was on Drudge or somewhere else. Facebook has had a consistent drop in teenagers and what they call tweens. I don't really know what a tween is. I guess that's a millennial. A tween is like coming into your 20s, I guess, from the teens. But there's a significant drop in the users for Facebook. Now, if an analyst comes out and says, I'm downgrading Facebook because of this, this, and this, and that analyst has millions of followers listening to him or her, what's going to happen? The very next day, or maybe even as the words are leaving that person's lips, the stock is going to drop. So they're pushing the market in a downward direction based on their opinion or their analysis. Well, we, the technicians, the chartists, see a bearish engulfing pattern that is much more powerful than someone's opinion, because this is hard evidence that there's supply and demand making a shift. And if I see a bearish engulfing pattern and now millions of people are reacting to that, we're all in a good spot, because that we're making that more effective. And also a bullish engulfing pattern is the same thing. We have a buy signal, but guess what? If we all react to a bullish engulfing pattern, let's say that the bullish engulfing pattern happened down here, we are all helping each other again in being able to establish a get out point or a stop level, because it's a clear support level that we could all use to manage risk. So tell people about this. Tell people, subscribe to the Market Guys, at least a weekly market report, to get some insight into and some lessons, so that we could all stick together as a trading community that reads the charts fluently. And that's my best bit of advice, is continue to tell people about this, and you'll be better off for it. So I went 1 minute over. Hope you're okay with that. I want to thank you again. Have a good rest of the week. Look forward to our next open house session, which will be the Monday after next expiration week alert. Just stay in touch with the Market Guys website, and you'll see it posted on the front page. Thank you, folks. Have a good night. Bye-bye.
For almost 3 decades, AJ Monty has motivated audiences worldwide about creating personal wealth and winning in business. His time-tested risk management strategies focus on ideas that involve a keep it super simple approach, also known as the KISS principle. These concepts have been delivered to people in over 16 countries around the world, reaching audiences in the millions. AJ is a best-selling author of 2 books, The Market Guys 5 Points for Trading Success and Take Charge of Your Money Now, both of which have been featured on PBS Television, Fox Business News, ABC TV, as well as Sirius Money Radio. As a financial educator and consultant, he has worked with some of the most recognized names in the financial industry. Companies like Bank of America, Charles Schwab, E-Trade Financial, Scotiabank, and TD Ameritrade's Thinkorswim. If you have ever been challenged with having to make a tough decision regarding when to buy or sell a stock, then help is on the way. The Options Oracle and Equity Oracle Alert services are designed to help you make those tough decisions. AJ will not only help you find the best trade candidates, but he will also lay out the exit strategy for each position in an easy-to-understand format that anyone can follow.
Hi, my name is AJ Monty, Chief Market Strategist for the Market Guys. For almost 30 years, I've traded stocks, options, futures, and even currencies. I've traveled the world teaching people just like you how to profit in the market using time-tested strategies that focus on risk management. You see, the secret to making money in the market depends on your ability to limit losses when you're wrong. In other words, if you want to make a lot of money in the market, don't lose a lot of money in the market. Now that may sound funny, but it's true. Most investors are challenged with 2 questions. The first question is, how do you find a good stock? Well, the best way to find the right stock starts with eliminating all of the stocks you would not invest in. This process of elimination is called stock screening. And our services help you overcome the odds so you're putting your money where the money is going. We're simply following the trends. The second question most people ask of me is, when is it time to sell? Well, if you don't have an answer to this question, then you might find yourself in a position where you're holding on to your stocks when things go against you. This is the worst thing you could possibly do, because I believe this is no longer a buy and hold market. It has evolved into a buy and protect market. Holding on and hoping for things to get better is not a strategy. In fact, doing this will eventually lead you to a catastrophic loss, and you wouldn't want that. Our Trade Alert services help answer these 2 questions. Not only will I help you find the right trade candidate, but I'll also show you how to use the charts to manage risk. I don't use the charts to predict the future. I use them to protect the future. The charts tell me when it's time to get out as well as when it's time to get in. And that's what I'd like to teach you as well. We have two services, the Equity Oracle and the Options Oracle. The Equity Oracle is an alert service for traders who would like to trade only equities, whereas the Options Oracle is our premier alert service for both equity and option traders. Each alert is laid out in an easy-to-understand format that shows charts depicting entry and exit points. Risk management is our cornerstone of each service, so you don't have to struggle with the decision of when to get out, or when a trade goes against you, when should I take my loss? The strategy is to use the KISS principle, keeping it super simple. As a bonus, you'll have access to a live Q&A session as well, each and every month. This is where you can submit a stock symbol, and I will analyze these stocks while we discuss the best trading strategies for each position. And it gets better. In addition to the alert service and the live monthly Q&A sessions, we're also developing a member page that will include instructional videos about how to get the most out of our service. Without question, this is the best trade alert service available on the market, and we look forward to having you as our newest subscriber. Simply click on the link below to subscribe. It's easy. Once again, I'm AJ Monty, Chief Market Strategist for the Market Guys. Thanks for watching.
Enrolling in this service is easy. Simply click on the link below to subscribe, and your weekly alert will be delivered right to your email box. And if you act now, we will include AJ's best-selling book, The Market Guy's 5 Points for Trading Success. This is a first-time offer that will get you on the road to success and keep you there. Remember, if you continue to do what you've always done, things will never change. Positive results will only come after you have taken the first step in the right direction. We look forward to having you as our newest member.